Tuesday, May 9th, year 2023. You, at some point, I would go into an in-depth analysis of the regarding the advanced accounting. I will demonstrate problems, solutions, and different way to look at advanced accounting and how it could impact your daily decision-making process with respect to making investment decisions, your goals, your concerns. The copyright of this video series, accounting video series, the one appearing on your screen right now, the disclaimers are there. The copyright of this video mentor series belongs to myself, Mijanur Rahman. Let's say, for an example, if you invest $100 in anything, could be, it doesn't have to be a publicly traded stock market or a private corporation. It could be anything. In fact, it could be a small venture between you and your friends, right? So an investment is an action where risk and rewards exists. The higher the risk, the higher the rewards. So in making investments, we need to make effective decisions. We need to make decision that is meaningful, that is thorough, that is precise and clear. Furthermore to that, corporations continuously make investments whenever they have excess cash on hand. This advanced accounting deals with corporate investments, investments in a short term, investments in a long-term horizon. It also deals with mergers, acquisitions, and business combinations. So overall, the advanced accounting deals with mergers, acquisitions, and business combinations. When two companies, they can merge to create synergy. Acquisition, a company can buy another company, A, through share, B, through asset purchase. And that is also can be known as business combinations. So, how these things happens, how investors, corporations make their investment decisions. Obviously, they don't make decision based on instant thoughts. They spend the time, they learn, they research. And once they make the investments, they would have to recognize, they would have to summarize that into financial statements. Financial statements is a snapshot what happens throughout the year. And each and every corporation has a fiscal year end. This fiscal year end can be elected at any day in a 12-month period. Your fiscal year end is one day. In our personal life, fiscal year end is December 31st. Many companies, they have same year end, and many don't. So now, by far, we know what is an investment. We know what accounting sectors we are dealing with, or segment. We are dealing with advanced accounting. Well, you might ask me a question, how advanced accounting is different from everyday accounting or accounting that is done by every other corporations, or how is it different from general accounting? Well, it's not so different. The fundamental of accounting are the same. The reason it is known as advanced accounting because the idea, the concepts, the financial transactions are complex in nature. And because of that complexity, the term advanced is added. Therefore, we come up with a new name called advanced accounting. Accounting, the basic, the fundamentals, every aspect of accounting that you use in 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 your general accounting for a regular corporation that doesn't invest, or a CCPC that doesn't invest to that extent, um, they don't need to use advanced accounting. Okay, once again, regular corporations use that does not have excess cash to invest would normally use general accounting that we every day see in a small business corporations. Okay, a CCPC is Canadian Control Small Business Corporation. CCPC doesn't have to be a small corporation. CCPC can be large. CCPC simply means Canadian controlled um, private corporation. So, so now we've got an idea. We know what is advanced accounting and what is our scope of our accounting, what we are dealing with. We know what is investment. Companies, just like you and I, just like every living person, a natural entity, a natural person, company can make investment decisions. Corporations are artificial entities. Corporations, they require to file tax return just like every other human being or natural entity or natural person. Corporations are required to elect a fiscal year end, file their tax return, do their bookkeeping, prepare their financial statements based on IFRS or Private Entity GAAP, also known as ASPE, Accounting Standard for Private Entities. So, corporations are complex, especially when it comes to their accounting. It is not that simple of personal tax return or personal accounting. So, without further delay, let's go through this advanced accounting. This is the very basic discussion. Before we get any further, we need to find out our scope of our work, our scope, the scope of our decision-making process. This is our scope of decision-making process. I'm going to highlight that in Kion. This highlighted in Kion is our mechanism in the decision-making process. Question highlighted in Kion. Are we investing below 20%? If the answer is yes, then we follow chart B. The chart B is right there. This is our chart B. And I'm going to unhighlight this. Now let's look at the highlighted section on the left-hand side in Kion, or some people they call it Sion. I like to pronounce it as a Kion. Anyway, are we investing above 20%? If the answer is yes, then we follow chart A. Chart A simply refers to strategic investment. Chart B, which is this side over here, highlighted in green, is non-strategic investment. Okay, so if you're investing above 20%, then we have a strategic investment. So let's work with the strategic investment first. So in our example, we have two companies. Perhaps I can show you this first. So we have this Anglo Limited. You can see the snapshot of their very brief, basic term, their revenue, expenses, and net income after tax. We assumed for simplicity the tax rate is 28%. The Anglo Limited is the purchaser. And this POP Inc. or Limited, I would have to change that in the Excel or Google sheet. The POP Limited, so we have Anglo and we have POP. Okay, so yes, both we used limited, so we'll have to change that. So the Anglo Limited and POP Limited. Okay, Anglo is buying POP. You can see Anglo has net income over 3 million, 3.6 million, where POP Limited has net income 264,000. Okay, so net income does not refer to liquidity. Sometimes company may sell their share for various reasons. Okay, we won't get to that discussion today. Okay, so the Anglo, this is our Anglo right there. This is our Anglo right there. Anglo wants to buy 20% of POP. The POP is right here. You can see that. Now here is my question. So this is in the first scenario. Anglo wants to buy 20%, highlighted in red right there, 20% of POP. Okay, and this is our one scenario. Second scenario is Anglo wants to buy 21% of POP or P. A wants to buy 21% of P. A is the first letter of Anglo right there, and P is the first letter of POP. So I put a note there that above 20% is significant investment. We'll get to that in a second. Whenever you see 21 to 50%, it would be considered a significant investment. Whenever you see the investment is less than or equal to 20%, less than or equal to, that's the term, less than or equal to, then we would have ordinary investments or non-significant or non-strategic investment. The proper term is non-strategic investment. So we need to keep that in mind. Now here you can see that. So let's assume that in this case, Anglo A bought 21%. This would give rise to a significant investment or significant influence investment, okay? This is to give you an idea, okay? Picture. I'm not so big fan of this, picture stuff, okay? This is our cutoff line right there. 50%. So any number above and any number, so perhaps I can show this to you here. Okay, any number, if this represents 20% and if this represents 50%, any number right here is your significant, it has significant influence. The Anglo, if Anglo by any percentage between this line over here and this two line shaded in red, that would be considered as significant investments. Okay, here in this example, Anglo bought 21%. So if this is about 20%, and the Anglo has to buy another 1% right there to make it 21%. This 21% gave Anglo a significant influence over the corporation. Okay, any number above 20%. People say at 20%, it is not significant. At 20%, it does not give significant influence. Perhaps I shouldn't say that in terms of number wise. Later on, I'll tell you this number, this percentage of ownership may not mean much if the company doesn't have control by way of, or some company could have 5% ownership. Anglo, these are just some idea, okay? Anglo could have, instead of having this 20%, Anglo could have literally 5% in POP. If this is our POP, and this 5% ownership, and if they had one or two board member, so board member, so if Anglo had owned 5% shares of POP and had the ability to, or had a board member on POPs, in POP Corporation, if then Anglo may be considered, it would have significant influence. Perhaps it could also give them control as well if all the board members from Anglo, then they would have to consolidate line by line. Okay, so we didn't get into that discussion now. Perhaps I can show you the number wise. Okay, so let's focus on the number for now. Okay, so now we're only focusing on number. The qualitative we'll talk about later. Okay, so the moment company surpasses 50%, that gives control. We own 51%. Anglo owns 51%. If Anglo owns 51%, then it's a control. They would have to consolidate their financial statements. So these are two public corporations. Let's assume that, okay? They're both public corporation. For example, real life, with that much of net income, it is highly unlikely for them to be public corporation. But anyway, just for our example purpose, they both follow IFRS. What is IFRS? So you know that it's International Financial Reporting Standard, IFRS. Okay. All right. So now, by the way, if these corporations were private corporation, then they would follow SPE. SP, SP refers to accounting standard for private entity. Also, you can say PGAAP, private entity GAAP. And GAAP stands for generally accepted, GAAP. It's not the clothing store Gap. Generally accepted accounting principle. Okay, that's GAAP stands for. Now, obviously, if you are listening to this video, or if you're watching this video, if you're listening to this audio series, then you must be an accountant, or you finished your accounting graduation, or you're working in the field, or you are an investment advisor, or a financial advisor, financial planner, or a lawyer who deals with publicly traded corporation advanced accounting to get an idea how to read their financial statements. Okay, so now what if, so we said earlier, 51% would give them control. At 51%, there would be a subsidiary. Okay. POP would be one of Anglo sub. So when you see POP, they could say, well, over here, if they had few other company they own, over here they could say POP, we own POP. I'm not a best drawing person, so perhaps I can draw it here. A stands for Anglo. If this is Anglo, if Anglo had few other investments like POP, let's say this is Con, and this is Ben. Ben, and think of something else. Ben Incorporated, Con Incorporated, and this is POP Limited. Okay, so they would show a chart. When you go to their website, you'll see this Anglo Limited or Anglo Incorporated. In this case, we chose Limited. The Anglo Limited own this many corporation, and then they would show us percentage. Here, let's say, for example, they own Ben. Perhaps I can write it properly here. So they would say we own 20% of Ben, 51% of POP, 10% of Con, okay, or 100% of Con, okay. They would show something like that. And so now, what if Anglo own 100% of POP? Then it would still be a control, and it's still required to consolidate. Anglo required to consolidate its financial statement at the year end, but the POP would be wholly owned. So the POP would be wholly owned, a corporation that is purely 100% owned by Anglo. So when an 100% purchase occurs, they can buy from the open market. B, they can buy they can buy at the get-go from the setup. They could, so to say, Anglo could form a company with 100%. That would be a part, that would be a acquisition as more of a business formation. They can also, instead of buying this 100% share, they can also choose to buy the asset. Okay, this is also known as a business combinations. Okay, so just in case you're wondering, so once the moment Anglo buys 100% share of POP, POP becomes a wholly owned subsidiary of Anglo Limited. Now let's go to the Excel sheet or Google sheet. So now we are back to our Excel or Google sheet. So we know at the beginning, at the get-go, that the moment Anglo invested 20% or more, above 20% or 21%, the moment when Anglo, or if Anglo invests 21% to 50%, then it would have influence over POP Limited, and that influence would be significant influence, and it would be part of an strategic investment. And with respect to strategic investments, I showed you here. Perhaps I can show again. In our example, Anglo buys 1,100 shares of a company named POP, or Anglo buys 1,100 shares of POP from the open market. The moment you see the word open market, you would automatically know, then you know that's a publicly traded company. Okay, I refer to Anglo as also a publicly traded company, but it could be a private entity as well. Okay, so the POP, at the time when the acquisition took place, then the POP Limited had 5,000 shares authorized, issued, and outstanding. Okay, so what do you mean by authorized? Well, the authorized, every corporation needs, before they incorporate, they would have to file an article. They'll have to file the paperwork. They would have to register the corporation. Upon registration of the corporation, they would be issued an article of incorporation. The government would give you a bunch of instructions and some questions that you would have to answer. In one of the questions, they would require the initial board of directors, okay, or the default directors, okay, and how much the corporation would require to how many shares the company would register or authorize. So the company can elect how many shares it can issue to public or to private individuals, whatever the method being. So that is known as authorized. So let's say POP Limited, when it went to Government of Ontario or Government of Canada, it said that we would only authorize the company POP Limited would be restricted to, it can only issue 5,000 shares at this time. If they need to issue more, they would have to amend the article of incorporation. Okay. So this 5,000 is known as authorized share. I'm going to show that in blue right there. Okay, 5,000. Okay, and they once they issue the company could have more share authorized. Instead of having 5,000, they could say 500,000, and they could only sell 5,000. Okay, so this is authorized, and this is issued. Okay, right there, highlighted in orange. So this is an example. So you know what authorized mean, issued means. Okay, so now, so how do you know if we met the numeric threshold? To be significantly to have a Anglo or A to have significant influence on POP Limited or P Limited, then it would need to invest about 20%. So does it have to be, can it be 20.01%? Of course, above 20%. Usually they refer to 21%. So now we know here, I formulated this for you here. So here we've got 1,100 shares that Anglo bought or A bought from P. The P had 5,000 share issued and outstanding. So divide that by that would give us 22%. So we invested 22%. The Anglo invested 22% in POP. And based on the investment, it has significant influence. Now, earlier I told you that a company could have 5%, it could be 5%, as low as 5% investments into this P Limited, POP Limited. And if they had board of directors in POP, remember I said articles of incorporation? At the article of incorporation, these board of directors are the officers of the corporation. They make decision. They may not be involved in day-to-day decision-making process, but they would definitely be involved in investment-making decisions, getting things approved by the operation managers, the investment center, the cost centers, the CEOs, the presidents. They report to the board of directors. Okay. So this board of directors have a lot of power. They have a lot of powers. When I say power, not powers. This board of directors have a lot of power over the corporation. So if Anglo appoints, have, let's say their CEO as also a board of director in POP, or one of their vice president is a board of director in POP, and they own 5%, then they have significant influence. Okay, let's say POP has, let's say 5 board of directors, and out of that, Anglo has appointed 3. They, by fluke or by method or by trick, whatever it is, then Anglo would have somewhat influence. In fact, if it is not significant influence, it also could be control. Okay, so be aware of that. So if it is not control, then it could have significant influence with the board of directors. Usually, given the power, given the level of control, they would choose whether it's a significant, whether it's a control. Okay. So now in our example, both the both Anglo and POP, they follow IFRS because they are publicly traded companies. Okay, for an example, if the Anglo, if the Anglo wasn't a publicly traded corporation, if it was a private corporation, Anglo A, then it can choose its cost method under SPE. Under SPE, Anglo could have chosen cost method. However, in our example, they are both publicly traded corporation. Therefore, by force, they would require to follow the IFRS. For publicly traded corporation, always equity method. For significant influence. For private entity GAAP or PE GAAP or private corporation, it can choose cost method under ASPE. Control. The control, the moment Anglo invest over 50%, it gave it control. And what happens in control? They both have to prepare. Remember, corporations are artificial entities, artificial persons. They have no death. They live forever. They can live forever unless they go bankrupt. Okay. So based on that, since each corporation is an independent entity, they would require to prepare financial statements. Okay. The Anglo in this is known as parent because Anglo bought 51% and POP is the subsidiary, which is which also required to prepare its financial statements on the December 31st. So now what's happening? Let's take a look at the example here. A buys 2,550 shares of company P from the open market. At the time of the sale or purchase, whatever you'd like to say, P had 5,000, perhaps I could change that to purchase. At the time of the purchase, P had 5,000 shares issued and outstanding. So now you'll see if we divide right here, if we divide 2550 by 5,000, you will know it is a control. It is 51% right there. Okay, I showed you here. So highlighted in key on cell. Okay, 2550 divided by 5,000. That would give you 51%. The moment you have that 51%, you no longer require an agreement. You no longer require to have a board of directors. Automatically, by default, you are the controlling entity. Anglo is now controlling literally and meaningfully controlling the sub POP or P Limited or POP Limited. And because of the 51% of investments, Anglo has control over POP. And it can appoint any board of directors it likes. Okay, it has more power. However, if those investment doesn't have voting rights, then they have no control. This has to be common shares, okay? So beware of that, common share with voting rights. And the moment it got 51% ownership in P or POP Limited, it needs to consolidate line by line at 51%. Then you might ask me, what happened to that 49%? Because POP has 100. Let's say POP. Give me 1 second here. Because POP is Anglo owns 51%, right? And it would still remain with 100 minus, maybe I could say 1 minus 51%. Okay, it would still remain 49%, and this 49% is owned by the non-controlling interest. Okay, you can see that right there. If you add these two, if you add these two lines over here, 51% plus 49%, that gives you 100%. Right? Anglo owns right there. This is our Anglo. I'm going to highlight that in Keon, and this is, I'm going to highlight that in green. Okay. The parent company Anglo is highlighted in Keon or Sion, however you like to pronounce it, and this is our consolidated. I could highlight that in yellow. Okay. So we need to know what each company is responsible for. So we know they would need to prepare financial statements for themselves, okay, at the year end. And then because of this 51% ownership in POP, Anglo needs to prepare consolidated financial statement highlighted in red. Okay, because of this control mechanism, I highlighted back in magenta. Because of this 51%, Anglo needs to, because of this 51% ownership in POP, Anglo needs to consolidate these two financial statements. Anglo would consolidate and prepare one. Think of this way. Perhaps we shouldn't. So now, at December 31st, I'm repeating that over and over again, so you don't make the mistake. They would need to, both companies need to prepare their own financial statements. And then, in addition to their own financial statements, Anglo, not POP, Anglo needs to prepare the consolidated. Okay? Think of this way. Think of, you have a family, and in your family, you've got 2 sons, and they're working for you. And they, let's put this way. This is you, Jack. Maybe let's say Ryan. Ryan is the father, and Nancy is the daughter, and Peter, or maybe I could say Peter Pan, maybe because Peter, yeah. Peter is the son, so Peter okay, these 2 person, the daughter and his Peter's Ryan's daughter Nancy and Peter, Ryan's daughter Nancy and son Peter, they're both under the umbrella of their father. Okay, so at the year end, if Ryan earned $10, Nancy earned $5, and Peter earned $6, okay, they would have to, what is their family value worth? Right here. Okay, what is their family value worth? 10 plus 5 plus 6, $21. Okay, so this would be, let's say, consolidated. Okay, right? This would be consolidated their financial situation, okay, their financial position. Okay, now let's say they both required to, let's say the Nancy only required to give 51% back to Ryan. Okay, so 51%, so 0.15, that's 2.55, and Jack has to give, and the Ryan himself is $10, right? So at the year end, you can see that right here. I'm going to maybe change the color here. Yeah, let's give it yellow. Okay. So we have this dilemma here. Okay. In this situation, in here, I'm going to highlight that. Over here, I'm going to box it and highlight it. Over here, and let's color that in cyan. Over here, they're both 100% obligated to Nancy and Peter to give everything back to their father, 100%. Okay, and over here, let's say they would only required to give 51% back to their parent. Okay, and if that's the case, at a 51% capacity, the ownership, or the 51% obligation, their family value, or Ryan's net worth would be $15.61. You see the difference? Perhaps I can show you here. Okay, I could say, so you can see it right here at 100%, when Nancy's and Peter's operations or earnings, when Nancy and Peter is obligated to return 100% back to their parent, then the family net worth is $21. And if Nancy and Peter is only obligated to return 51% of their income, then their family income would be not net worth income would be $15.61. Okay, right there. That's the only, this is just a concept. Okay, what it means, the consolidation. Does it work like that? Not quite, but you got an idea. So now these are very basic. So what do you know? At control capacity, The Anglo Limited need to prepare its own financial statements. POP Limited needs to prepare its own financial statements. Once they both come up with their own financial statements, then there's an extra step that Anglo needs to prepare. The Anglo needs to now prepare a consolidated financial statements for the end users. Okay, very important. So don't get confused. Anglo prepared two statements, one for itself and two the consolidated. We'll get to that the special purpose entity a lot later. So now that we are done with the strategic investments, we can talk about the special purpose entity later on, not to confuse you. This special purpose entity is also a strategic investment, but it is dealt differently. So we'll talk about that later. Again, highlighted in gray is on the screen you can see, is the special purpose entity, and I will talk about it a lot later with respect to a special purpose entity. For now, in briefly, the special purpose entity can form by way of an agreement. At the same time, you must have some, you may or you may not own common shares. One party could own common shares, the other party could have working interest or managing the business, right? So the special purpose entities, they two or more parties carrying out a specific task. I wrote down the criteria here for you. And then you would have control through legal agreement or contract. And the purpose are structured, or the purpose are structured through various forms. Thereafter, so what you would have is that based on the agreement, control, and the purpose, you would set out your special purpose entity as a joint operations or joint venture. Okay, with respect to joint operation, the joint operation requires proportion. It can follow proportional method or consolidation. Once again, it can choose between these two based on the election or based on the merits or the criteria. They can have proportional method or they can follow consolidation method. This is the joint operation. With respect to joint venture, you would require to follow equity method regardless of any, whether you follow, whatever your specific criteria is, whatever your contract says, whatever your specific purpose is. They will have I'll produce a detailed video mentor series for the specific purpose entity. So now let's forget this for now. So I'll hide these rows here. Now we move to the part B. That was our non-strategic. So chart B, because whenever we invest less than 20%, right there highlighted in green, the investment would be categorized as non-strategic investment. So we can also hide this as well. Okay, so we follow this green right there. And chart B is non-strategic investment where Anglo or any company invests less than or equal to 20% would consider as a non-strategic investment. Well, non-strategic investments they have two methods they can use. One, I'm going to highlight that in orange right there. You can see that perhaps a different color, perhaps magenta. Fair value. Both method uses fair value. However, one of them is fair value through profit and loss, known as FVTPL, and the other method is fair value through OCI. OCI refers to other comprehensive income. So fair value through profit and loss, and fair value through the other comprehensive income. Well, at what time, when do we choose that? What is our criteria? What is our election method? What qualifies Anglo to choose? So let's say, for example, here, this is our example right here, okay? So the way it works is that let's assume that Anglo buys 100 shares of P. A company buys 100 shares of P company from the open market, or whatever the method might be. In this case, it's not so relevant. At the time of the purchase or sale, P had 5,000 shares outstanding. So right there, so so P company's total shares 5,000. I'm going to highlight that in Kion. You can see that right there. And then Anglo invested 100 shares in POP. Highlighted that in Kion. You can see that. So based on that, you can see, based on the investment, the Anglo doesn't have control. Anglo doesn't have any influence. Okay, it only has 2%. Okay, based on the investment alone, without the board of directors having in place, it has no control, no influence over POP. Therefore, it meets the criteria of non-significant or non-strategic investment. Non-strategic investment. And how do we choose? What method should we choose? Should we choose FVTPL or should we choose FVOCI? So remember, whenever you go to an investment company, as a person, it asks your goals, your concerns, your intentions, how long you want to hold the money for, what do you want to invest, the type of investments. So goals and concerns, intentions, okay, scenarios, intentions and scenarios force the company to choose the accounting method. So Anglo had only 2%, and its intention is not to hold in the long run. Okay, they want to invest for short term. So once the investment is short term in nature, okay, and the investment could be held for trading or available for sale, just like bond, okay, just to give an idea, okay, or they want to hold it for really short time, they're just trying to make some money, they want to be a day trader just for fun. Anyway, never mind. That's not a good example. Okay, so they want, when the investment is for short term, and then they would follow. And what is the short term? It could be 1 year, or it could be, usually 1 year, okay, or lesser than 1 year, with respect to companies, okay. and then they could choose a BTPL, fair value through profit and loss. And whenever an unrealized gain losses triggers, the company has to report that in its financial snapshot or in its financial presentation or in its financial statements. Okay, so they would have to adjust their investment based on the unrealized gain loss. Not adjust the investment, I apologize. The company has to recognize those unrealized gains and losses in their financial statements. Okay, any event. So if the market goes down, they would have an unrealized loss. If the market goes up, they would have unrealized gain. Okay, so the company has to follow that. With respect to the criteria, the scenario is the same, but the time horizon is different. Okay, the FVOCI, it's like holding that you don't meet the strategic investment, right? You don't have above 20% investments. You don't have influence on the company, but you really like the company. Anglo really like pop company, and they want to invest. They want to have that investment for 10 years or 25 years. Who knows? Okay, and because they don't have enough money to invest in pop, they would have to recognize that, and they would have to present their financial transactions with pop under the FVOCI method. Okay, the company still needs to follow, both company, because the Anglo and pop, they both are public company in this. They need to follow IFRS. Okay, with respect to whatever they need to do, they need to follow IFRS. BTPL and FVOCI is a method. It's a calculation method, a recognition method. Okay, so not to get confused. So here you can see it here. The calculation, I kept it same. The calculation is no different from the above, but we are counting journal entries. When I say calculation, I'm meaning is that come up with the formula, come up with the percentage of the investments. You'll see under the both method, when I show you an example, the FVOCI and FVTPL method, a company could have significant difference in their earning in their reporting. Okay, so be aware of that. Okay, so hopefully you had fun. Just to give you a snapshot, investment over 20% is a strategic investment. Investment below 20% is non-strategic, and the company's accounting method will vary based on the amount of investments, a contract, whether there is a specific contract in place, or if they have a board of directors control without investments on the company or with investments on the company. Okay, based on these three criteria, a company would make the decision. Okay, so be aware of that. A company could, with 5% investment and having a board of directors, majority board of directors, influence over that, they could have influence or control over the other company. Okay, if all the board of directors is owned by, in our example, in POP Limited, if all the board of directors are appointed by the Anglo, then the Anglo has to do, they would have to produce consolidated financial statement. Okay. However, if they have one or two out of five, five board of directors that POP has, or the POP Limited has, then they can choose to use significant influence method. Today is Tuesday, May 9th, year 2023.